When we look at variances and we see that they are either favorable or unfavorable, what we really should be doing is digging deeper and trying to figure out why are they favorable? Why are they unfavorable? And standard cost and variances, this variance analysis, allows us to gain some of those insights. So the first thing we're going to do is for a particular product, we're going to set price standards and quantity standards. Price standards, how much should we pay for a certain amount of input? So if we're making pizzas and cheese is supposed to cost $3 per pound, that is our price standard. If we pay $3.10 per pound, that will cause an unfavorable price variance. If we pay $2.50 per pound, that would be a favorable price variance because a lower expense leads to higher profitability, higher expense leads to lower profitability. Then we also have quantity standards. How much of an input should we use in a particular product or even to deliver a service? Sticking with the pizza theme, if a certain pizza requires 16 ounces of cheese, then if we use 18 ounces, that would produce an unfavorable quantity standard because we're using too much of an input and that will adversely affect our profitability. If the standard is 16 ounces per pizza and we use 14 ounces, then that would actually be a favorable variance because that should lead to greater profitability, at least in the short run. And we'll talk about that concept a little bit more later. So this standard price per unit, we're going to take a look at material standards. The standard price per unit is going to be that final cost of our materials, net of any discounts and including any shipping to obtain the cost. The standard quantity per unit is going to be in the bill of materials. The bill of materials is essentially a menu of the items that make up a particular product, and those quantity standards should be specified there. When we look at labor, the standard labor rate per hour, a lot of times it's a single rate that reflects a mix of wages earned, but we could disaggregate that if it's appropriate for our company. That's a managerial decision. But either way, we're going to come up with a gold standard for labor. This is what we would expect a fully burdened cost per hour for our employees. And then there are standard hours per unit. How many hours or minutes should it take for people to make this product? And that's where time and motion studies come in and give us some insights to help us set that standard. We can also set standards for our variable overhead. We can look at the variable portion of the predetermined overhead rate and for the price standard, and then the quantity standard would be whatever that activity measure is, that cost driver in the allocation base for the predetermined overhead rate. This is an example of how it might all come together. So for a particular product, we might have a standard of 3 pounds of material for that product. That's our quantity standard per unit. And if the standard price is $4 per pound, then we would expect to spend $12 of materials for one product to be completed. Direct labor, we expect 2.5 hours of labor. The standard labor rate is $14 per hour. So each product should have $35 of labor cost built into it. And then finally, in this case, if we are allocating variable manufacturing overhead based upon direct labor hours, remember that doesn't have to be the only cost driver, but in this case it's what we have. We use the same 2.5 hours of labor because that is our allocation base for the variable overhead. And our standard rate is $3 per hour, which gives us a standard cost of $7.50. So what this is telling us is if everything went perfectly, exactly according to plan, we would use 3 pounds and it would cost us $4 a pound. Our workers would spend 2.5 hours. We would pay them $14 per hour. The variable overhead would be $3 per hour. And the perfect cost would be $54.50 for this product. Now, if that ends up being a different cost, let's say our unit cost actually ended up being $55. We have to start asking ourselves the question, why? Is it because we paid more than $4 per pound for the materials? Did we use more than 3 pounds of material? Did we incur labor that was greater than 2.5 hours. Maybe the labor rate was too high. These are the questions we're going to be able to answer when we look at these variances and do the variance analysis. So there are 6 major variances. As we take a look at a price variance, we have the difference between the actual price paid and the standard price. So what we can see is we're going to have for materials, we would have a materials price variance right there. For labor, now we don't call it a price variance because it's people. You don't put a price on people. So we call it a labor rate variance. And then with variable overhead rate variance. So these are the 3 possible price type variances we would have. Materials price variance for materials, labor rate variance for labor, variable overhead rate variance for variable overhead. And each of these deals with the price that the company has to pay to obtain these items, to either obtain the materials, to have workers working for them, or to incur variable overhead expenses. On the quantity side of things, we would have a materials quantity variance. Did we use too much cheese on the pizza? Did we use too little cheese on the pizza? The materials quantity variance is going to explain to us the financial impact of too much product or too little product as far as inputs. So in other words, inputs to our product. And then when we get to labor, we would have a labor efficiency variance. If our employees work too many hours for the level of output, then that would be unfavorable. If they work fewer hours, then it's favorable. We can also have the variable overhead efficiency variance. So what you're seeing here is that there are 6 variances. There are 3 price-related variances, 3 quantity or efficiency-related variances. Once you know how to calculate one of these variances, the other ones fall in line pretty easily, and they have a common structure that should make it easy. Once you understand one, you should be able to understand the others. The general model for variance analysis, and remember I told you that if you understand how to calculate one of these sets of variances, you should be able to comprehend the other 2 sets of variances. For example, if you know how to do the materials price variance, then the labor rate variance and the variable overhead rate variance, they have similar structure and it should work out well for you. And similarly, if you know how to calculate the materials quantity variance, then you shouldn't have any difficulty with the labor efficiency variance and the variable overhead efficiency variance. And the reason is this thing that looks like a March Madness bracket in the NCAA basketball tournament. Who's the winner, who's the loser? Well, the winner is going to be you when you understand how to calculate these variances. The general model for a price variance is this. And keep in mind that think about the word variance. What is varying between 2 things? Well, if we're trying to figure out how much the price varied from our expectation or from our standard, then what we need to do, we need to keep something constant. So we're going to keep the actual quantity constant, whether that's the actual quantity of materials, so pounds of material, for example, or if that's the actual quantity of hours, like labor hours, for example. We're going to keep that constant as we calculate this variance. We need to isolate what is actually varying. And then we'll take a look at the actual price compared with the standard price. That's what's varying. So the price variance is simply your actual quantity times your actual price, and that's going to be a dollar amount, compared with your actual quantity times your standard price. This is going to give you the dollar impact of any increases or decreases in price when compared with the standard. Now, the next thing we want to do is we want to take a look at the general model for quantity variance. With the quantity variance, we want to isolate the quantity by keeping the price constant. So what we're basically going to do is we're going to take the standard price, and that's going to be the same in both components of the quantity variance. And what we want to look at is our actual quantity compared with what the standard is. So now what we're doing, and this is, in my opinion, is relatively powerful, because what we're doing is we're taking a look at the difference in quantity, actual versus what we expect. So in other words, 3.1 pounds of cheese versus 3 pounds of cheese, for example. And we're taking that non-financial factor and we're turning it into dollars. So what we're doing with a quantity variance is we are isolating the dollar impact, the financial impact of using too much or too little of a particular input. What we'll see overall is that once you know the price variance and you know the quantity variance, it will all boil down to an overall spending variance. Without this variance analysis that goes into the great detail of price versus quantity, all we would see here is the spending variance. If you take a look at just overall budget versus actual, like whether it's a planning budget, whether it's a flexible budget, this is what you would see in a budget versus actual report. And that gives us some information, but it doesn't let us point the fingers. So what's really going to happen here is we're going to be able to try to determine what is causing that variance. Sometimes in the classroom, I refer to this as like the drama chapter or the soap opera, because we would say, oh, the variance, we spent too much on materials because purchasing manager, you're getting kickbacks from a supplier and we're spending too much per pound and it's your fault. And then the purchasing manager could kind of go back to the production supervisor and say, I don't think so. It's your fault because you have such shoddy workmanship and the quality of the products is bad and the defect rate is bad. So we're just spending more on materials because the quantities are too high. And then the production supervisor can come back and point his finger at the purchasing person and he can say, no, it's your fault because you're buying low quality materials and we have a lot of rework because of that. So this has the potential to be the drama chapter. I don't think I'll ever successfully turn it into a television show, but we are trying to, well, not point fingers, but we are trying to answer questions. So if a variance is unfavorable, let's figure out why so we can fix the problem. We made it this far, we better do some math. Let's calculate a materials variance, okay, or materials variances, I should say. So let's look at this scenario. We're making parkas. The standard quantity is 0.1 kilogram of fiber fill per parka. So we make a parka, it's supposed to take 1/10 of a kilogram of this product. And the standard price is $5 per kilogram. Now, what we're seeing here is that we spent $1,029 to purchase 200 kilograms of raw material to make 2,000 parkas. And what we want to find out is, do we have a spending variance overall? And is that spending variance favorable or unfavorable? Then we want to disaggregate it and look at the price and quantity variances. So let's look at the actual quantity. The actual quantity here was 210 kilograms. And the actual price that we paid is $4.90 per kilogram. Now, I can already look at this and I can see that we're probably going to have a favorable price variance because the standard price is $5 a kilogram. We spent $4.90 per kilogram. That's a 10-cent savings, so keep that in mind. And so what we're seeing here is that's $1,029. Now we go over here. We want to hold the quantity constant because we're trying to figure out the variation in the price. So 210 kilograms is what we purchased and used. And the standard price is $5 per kilogram. Comes out to $1,050. And what we see here, no surprise, is that our price variance, our materials price variance, is going to be $21 favorable, okay? Which we predicted because the actual price was less than the standard. Now let's go to the quantity variance. What we want to do with the quantity variance is we want to hold the quantity, we want to let the quantity be variable, hold the price constant. So we're going to keep the $5 per kilogram, and we're going to look at what was actually used. We actually used 200 kilograms in production. So what we're seeing here is that, or we actually used 210, pardon me with that. We actually used 210 kilograms, but the standard would be 200 kilograms because to make 2,000 parkas at 0.1 per parka, we should have used 200 kilograms. So I can already tell you this is going to be unfavorable. And here's the reason why. We're supposed to use 200 kilograms. We actually use 210 kilograms. As we take a look, let's finish the math here. Should have been $1,000 there. Our materials quantity variance is going to be $50 unfavorable because we used too much stuff. Remember what the quantity variance is really doing is it's trying to help us translate a variation in quantities, so in other words, number of kilograms of input, and express that in terms of dollars. Once we take that variation in the quantity of input, multiply it by the standard price, that allows us to see the dollar impact of the variance in quantity. If everything went exactly according to plan in a perfect world, let's look at what that would look like. So we make 2,000 parkas, and we're supposed to use 1/10 of a kilogram per each parka. So we should use 200 kilograms of this fiber fill. And if the standard price is $5 per kilogram, then in a perfect world, we should have spent $1,000. Okay? This would be, here, I'll call it utopia in this case. Okay? Everything is exactly going according to plan. Well, the actual amount we spent is over here, $1,029. So our overall spending variance is going to be the difference between these two. If we compare these two numbers, we can see that is $29 unfavorable. Okay? Why is it unfavorable? In a perfect world, we would have spent $1,000. We actually spent $1,029. Now, the reason I'm showing you this is I want you to understand that these price and quantity variances, they ultimately explain this variance. So overall, our materials variance, the spending variance, was unfavorable to the tune of $29. Why? Well, part of it was we used $50 too much material, so our materials quantity variance was unfavorable to the tune of $50, but the price variance was favorable to the tune of $21. 50 minus 21 equals 29. And since the unfavorable variance is greater than the favorable variance, overall, this becomes an unfavorable spending variance. And this is where the finger pointing starts. Did manufacturing use too much material? Maybe they did. Was it because, maybe the reason the price variance is so favorable, maybe purchasing department is using inferior products. And that's causing us to save money on the cost of the input, which would give you a favorable price variance. But if we're buying poor quality materials, maybe there is a lot of rework. Maybe there is a lot of scrap. We're not going to answer that question in this video, but it gives you a sense for the types of discussions that this information can facilitate. As you take this spending variance and disaggregate it into price and quantity components, it helps you target the reasons that these variances exist. Now, the general formula or model for variances uses an analysis that looks like this. I just want to show you an alternate way to calculate and to think about these. So the materials price variance, one of the ways you can look at it is to start out with what we had determined here. And we didn't do that calculation earlier, but I think you can figure out where that came from. So take the actual dollars we spent and divide that by the number of kilograms that we purchased. And so the actual price that we paid is this $4.90 per kilogram that we saw over here. And if you bought 210 kilograms and you save 10 cents per kilogram, then the math becomes relatively straightforward, and you can see this $21 favorable price variance. And just another way to approach the materials quantity variance is to look at it this way. Okay, the standard would be, and we see this over to the right, 2,000 parkas times 1/10 of a kilogram per parka. So the standard would be 200 kilograms of material. Well, I look at it this way. 210 kilograms actual minus the standard of 200 kilograms. That means we used an extra 10 kilograms. And at a rate of $5 per kilogram, that extra 10 kilograms ends up costing us $50. Which nicely reconciles to this unfavorable variance, so we calculated that way as well. So you've got a couple of different ways to tackle these variance calculations. And as I promised, if you understand how to calculate the materials price variance, you should have no difficulty with the labor rate variance or the variable overhead rate variance. And if you understand how to calculate this materials quantity variance, it's the same methodology when you approach the labor efficiency variance and the variable overhead efficiency variance. So my advice would be this, is really master the calculation, understand the calculation of how the materials price variance and the materials quantity variance get calculated, and then you can simply apply those same techniques, concepts, that same logic to the labor and the variable overhead, and you should be just fine. We're still making those parkas, but now we're going to take a look at our labor variances. The standard number of hours is 1.2 labor hours to manufacture a parka. And the standard labor rate is $10 per hour. I would argue that it probably should be higher than that amount, but $10 keeps the math kind of easy here, right? Now, if we're going to do a labor variance here, the actual quantity becomes actual hours, okay? It's still a quantity, but it's a quantity of labor, so we call it actual hours. Actual price becomes actual rate, okay? So let me just kind of make sure we're crossing that off. So it's an actual rate. It's a price of labor, but we call it a labor rate. The actual quantity here becomes actual hours, and the standard price becomes the standard rate. Over here, the standard quantity becomes standard hours, and standard price becomes the standard rate. Do you remember when I promised you that we should be able to replicate the logic, the methods with the labor and the variable overhead variances if you understand the materials variances? This is what I'm talking about. If you know the general formula for materials price and quantity variances, you should have no difficulty whatsoever with the labor rate and efficiency variances. So if we take a look at the actual hours, employees worked 2,500 hours, that's given to us. And the actual rate was $10.50 per hour. Okay. You might ask yourself, how does he know it was $10.50 per hour? Okay, well, let's just look over here. The total dollars was $26,250. Employees worked 2,500 hours. That comes out to an average of $10.50 per hour. There. All right, let's go back over here. Multiply those together. We get $26,250. We're halfway to a labor rate variance. Now, in order to measure the impact of the rate variance, we need to leave the hours constant in this analysis. So we'll still have the 2,500 hours right here. And now the standard rate, right? $10 per hour. So what we're supposed to spend. So what we're supposed to spend for 2,500 hours is $25,000. Try to disregard the fact, I know that you might be thinking, seems like they worked the wrong quantity of hours, maybe too many hours. Try to keep that out of your mind for now. What we're trying to do here is saying, regardless of whether or not you're supposed to work 2,500 hours, employees actually did work 2,500 hours. So let's figure out the dollar impact. And the dollar impact is going to be the difference between these two right here. And that comes out to $1,250. And it's unfavorable because we should have spent 25 grand for that number of hours. We actually spent 26,250 for that number of hours. And what you can see also, kind of the shortcut solution, look at it this way. That's an extra 50 cents per hour. So an extra 50 cents per hour times 2,500 hours gives you a $1,250 unfavorable variance. You can do it this way if you want to do it kind of the shortcut way. And quite frankly, I'll just tell you, this is the way over here that I typically do it because it helps me conceptualize. I can take a look very quickly and say, well, the standard rate is 10. We actually paid $10.50. That's an extra 50 cents per hour. Bigger expense. It's unfavorable. How many hours did we work? 2,500. I can get you to that unfavorable variance right away. Let's look at the efficiency. So kind of like the materials quantity variance, now we're going to look over here at efficiency. Let's start out with this time. We're making 2,000 parkas, and the labor standard is 1.2 hours per parka. So the expectation is this. If we're going to make, how many parkas? 2,000 parkas. If we're going to make 2,000 parkas, our employees should work 2,400 labor hours. So let's put that over here, 2,400 hours. And I can already tell you right off the bat that this is going to be an unfavorable efficiency variance because we were supposed to have 2,400 labor hours. We actually had 2,500 labor hours. I can already tell you there, unfavorable. We used too many hours. I just haven't taken the time, we're about to, put some dollars on these. So what you want to keep constant, you're letting the hours vary, just like with the materials earlier. But now let's keep this standard rate constant, $10 per hour. That's what's going to allow us to put dollars onto this efficiency variance. So standard hours times standard rate, 24 grand. If we compare these right here, that ends up being $1,000 unfavorable. We can double check it. I'm a huge fan of double checking. And why wouldn't you? If you have a way to double check yourself, you can almost grade some of your own problems on exams. Do it one way, double check it the other way, smile, move on to the next question, or go home once the exam's done. It'll give you a confidence level, and it will uncover mistakes and help you correct those mistakes. So let's double check it. The standard is 2,400. We actually used 2,500 hours. That means that we used an extra 100 hours. All right, well, what's the financial implication of that? Well, if the standard labor rate is $10 per hour, I'll tell you what the financial implication is. That's an extra $1,000 of labor cost, which is unfavorable if you're trying to generate a profit. If double checking is great, then triple checking is even better. Accountants love that kind of stuff. And the way we can triple check ourselves is to take a look at the overall labor spending variance. In a perfect world, I believe in a different segment of the video, I called it Utopia. If we manufacture 2,000 parkas, and if our employees work exactly as planned, they're supposed to incur 1.2 labor hours per parka. That means that in a perfect world, we would incur 2,400 labor hours total. And the standard rate up here is $10 an hour. So if that's perfect as well, the math ends up being relatively simple. That's $24,000. That's what we would spend on labor if everything went exactly according to plan. But it didn't. Look at our actual labor expenditure. It was north of $26,000. So I would compare that with our actual expenditure, $26,250. And what you see is the difference here. What do we have there? $2,250. And it's definitely unfavorable because the actual expense is more than the expectation. And guess what? The labor rate variance, I called it a price, it's really a labor rate. The labor rate variance and the labor efficiency variance are both unfavorable. $1,000 plus $1,250 adds up to $2,250. You have a triple check. Your overall labor spending variance should reconcile with your individual price and efficiency or rate and efficiency variances for labor. Variance analysis brings a lot of good things to a business entity. For example, it allows us to have management by exception. It's an efficient way for us to see if the train is going off the tracks. All we have to do is take a look at those variances on a routine basis, and if things become unfavorable or too favorable, sometimes too good could be a sign as well. But simply by taking a look at those variances, it can alert us to potential problems. So we could set up parameters or thresholds, and if a variance goes outside of those prearranged parameters, then we investigate. It can simplify things. It certainly does let us, well, I joke, point the finger, but it does facilitate responsibility accounting. And it allows us to figure out why something is happening, not necessarily so we can blame people, because that's actually one of the disadvantages we'll talk about in a second, but so we can figure out what to do to fix it. And yes, if you use that responsibility accounting improperly, you certainly can have morale suffer, right? People, you want to use it constructively, and so you have to be cognizant, be aware of the message you're sending. Yes, if there's a problem, we need to fix it. How do you do that in a professional manner that does not destroy employee morale? The labor variances assume that labor is variable, may not always be the case. Now, in a concept or a spirit of continuous improvement, simply meeting the standards, just meeting the standards, that might be okay for now, but that might not be sufficient in the long run. In a world where we're always looking for bigger, better, more efficient, more attractive, more profitable, there probably is going to be a push that, hey, if you're meeting the standards, why don't you do even better than that? And then I'd like to really park on this bottom quadrant for a second. We've hinted at it a few times in this discussion, but now I want to just lay it out there. Sometimes a short-term favorable variance could be bad in the long run. Let me explain what I'm thinking about here. Remember the pizza. Now, if the standard is for the pizza to have 16 ounces of cheese per pizza. All right. Now, if I own the pizza restaurant and I'm looking to enhance our profits by trimming expenses, what I could do is I could tell our pizza cooks, guess what? On this size pizza, we're going to do 13 ounces. Okay? The actual quantity will be 13 ounces. This will translate to a delta of 3 ounces, and that will be favorable in the short run. That will give you a favorable materials quantity variance. You're probably thinking ahead of me at this point, and you may be assuming what I'm about to say is that in the short run, that will save dollars, that will enhance profits, favorable quantity variance. In the long run, if the quality of our products suffers, then we may lose customers, and in the long run, that could be unfavorable. You could do the same thing with labor. In the short run, we could save dollars and enhance profits by scheduling fewer employees for fewer hours. But if it becomes complete bedlam or chaos in that restaurant during a busy period and customer service suffers because of that, that short-term favorable variance in the long run could definitely be unfavorable.